here's an interesting statistic. Somewhere between 7 to 8 deals out of 10 are basically sourced proprietarily, meaning no banker, no advisor. Hey, I'll give you $10 million. Well, it sounds great, but is that really the right value?
That's kind of ridiculous that they're not even doing the due diligence of like, what is my company even worth? How can I set up to structure this the best possible?
What happens is you start out the business, you get going, you get inertia, sales, everybody's tracking revenue. At the end of the day, your business is valued on profitability. Making sure that, having kind of that frame of mind saying, well, we do need revenue, but we also need to make sure that our revenue is getting accounted for properly.
Be aware there are things you can know that will work to your advantage, and you've got to find people who can help you with those.
Expert advice, practical tips, real life stories. Have less stress, more time, and more money in your business. Welcome to the Cash Flow Contractor.
Martin, we're talking about deals today, talking about business buying, business selling. We've talked about this in the past, but not with an investment banker. And
No.
You were so gracious to kind of inform me a little bit about some of the differences between brokers and bankers and all that good stuff.
Well, I gave you my opinion, and maybe we'll get a professional opinion here in just a minute. Because there are differences, and people who, even with really good businesses, I mean, more than once I've had people say, my buddy down the street will give me $8 million. I don't need to talk to anybody. And so is that true? Is that not true? Maybe we'll get some advice here.
Yeah. Well, Christian, welcome to the podcast. It's a pleasure to have you.
Yeah, thanks for having me, guys. I'm excited to talk deals, especially as the economy, hopefully, fingers crossed, starts to be ramping up, and we get a cut in interest rates, and everything we had planned to start the year of 2025 starts to materialize, in kind of Q4 and into 2026.
Maybe share with us how interest rates have affected business buying and selling.
Yeah, no, especially too, kind of given kind of your audience and the contractor base, if I go back, kind of circa like 3 years when obviously there was COVID, there was, interest rates were held at zero for quite a while. There was a lot of consolidation, acquisition activity kind of in and around the space because contractors were deemed an essential service and everybody, it's kind of like, people were not investing in manufacturing or distribution or some of these other types of business services. And so the focus kind of came to the residential and to the contractor. And, we saw like a lot of flurry of activity with, and Martin, probably same with you kind of in your world, but, anything kind of with an EBITDA was getting acquired. And so there was a really fast and furious run to kind of, it was like, I kind of likened it to like a land grab. In specific, markets, all across the country. And, as soon as then, the economy kind of started to stabilize coming out of COVID, interest rates started to come up, consumer financing went from zero to whatever, kind of based on credit scores and the, debt. Also, the interest rates, accelerated just kind of from a macro perspective. You saw a lot of these, kind of consolidators or financial sponsors, if you will, private equity groups, instead of just focusing on acquisitions, now they had to kind of integrate. And so there was a brief kind of pause for about a year or so. Well, interest rates were high. Most of these guys were kind of, I would say integrating their businesses, if you will. And now kind of, what we see is, everything kind of like leveling off, kind of stuff kind of getting back to what I would say some sort of level of normal. And everybody now is kind of like looking back, looking out and saying, all right, well, we're ready to kind of, rock and roll and start to move. So, what I think, and again, we got to kind of keep our fingers crossed, but, upcoming rate cut, lowers interest rates across the board for consumers and for businesses. And so, we're hoping that kind of spurs another level of investment activity kind of across, across the investment landscape.
Yeah, for sure. Well, I think let's go ahead and at the outset kind of define some of these terms, kind of like the brokers versus bankers, but let's kind of outline, what the differences are there. What is an investment banker? And then even private equity, you talked about integration. What does that mean? So let's just kind of define some of these things for our audience, just to get people up to speed in case they're not.
Sure. Yeah. So maybe kind of start with, the kind of the role that our firm, Footprint Capital, kind of plays in a process. And, I think there is that kind of investment banker, name or kind of cliche, but, at the end of the day, we're M&A advisors. and we advise both kind of sell side and buy side, of a transaction. And typically, most of our deals are done on the sell side. So we're advising kind of our privately held entrepreneurs, family owned businesses in their sale to what we call like, first institutional capital, which would be, like private equity. And private equity has a lot of different flavors. It could be a family office. It could be, a fundless sponsor or an independent sponsor, what they call them, or committed capital fund. There's just a whole myriad of different kind of choices out there or flavors. And really kind of when you boil down our job when working with our clients is to go and explore kind of all those different avenues, making sure that we're finding the right fit and basically kind of creating a market clearing price for the business that we're selling. And so, I'd say that's kind of it's soup to nuts kind of, that's our business model. And that's what we do on behalf of our clients. Now you got, some other different flavors of M&A advisors. So I think, from our perspective, I mean, we're pretty white glove, have a lot of relationships in the industry. We go to conferences, we network with all the buyers, we're understanding trends. What are they looking for? Having conversations, quarterly check-ins with a lot of these, quote unquote, kind of financial sponsors and investors to really understand kind of what the market drivers are, not just that have been in the past, but also kind of what are they looking to do. And so, we're bringing a lot of that advice and expertise to our client base, as we prep and manage a transaction. Some of the brokers and, there's a lot of, I'd say, kind of brokers, buy-side brokers, professionals that are making introductions, et cetera. Typically, that is, if they're working for you on the sell side, they're going to blast it out to 400 or 500 individuals, put it online. You're going to get a lot of noise, versus kind of going directly to, the quote unquote kind of right targeted, buyers for a business. So it's kind of like, I don't know, Walmart versus like, shopping at Walmart versus like a Neiman Marcus or a Nordstrom's or something that's a little bit more specific. And that's kind of how we operate, our practice.
Gotcha.
When
Okay,
we throw the name banker in there, it implies that there's money exchanging. Do you fund some of these deals? I mean, just to put away the idea that.
No, we're specifically, an advisory,
Right.
shop, on that side
Gotcha.
of it. So
Great. So you mentioned different flavors of private equity, from the family office to the fundless. Can you explain when you're thinking about getting acquired by private equity, what the different flavors mean and why you might, seek a specific type of private equity fund versus a different one?
sure. No, absolutely. Well, there's obviously there's a lot of funds kind of in your traditional kind of hubs of, at least like talking on a domestic basis at the West Coast, LA, San Francisco. You've got Chicago kind of in the Midwest, and then you've got, New York and Boston kind of as, I would say kind of those are your, kind of financial capitals from a private equity perspective. And so when you kind of break down the private equity landscape, you've got, family offices, which are typically like high net worth individuals or legacy families that, as part of kind of their overall portfolio, they have stocks, they've got bonds, they've got real estate. And then they kind of have a small little allocation or a pool of that they dedicate to private or alternative assets. And one of those being, potentially venture capital, which is, hey, I'm investing in a market, I'm trying to find a product to solve that issue, which that's venture capital. And then you got private equity, which is typically investing in kind of cash flowing, businesses where there's an opportunity to consolidate, expand, grow. Typically our transactions, private equity gets kind of a bad take when you see the deals in the Wall Street Journal, because those are like massive multi-billion-dollar deals where, there's a good portion of that to make that deal work. There's synergies and cost reductions and stuff to make that work. But when you talk to a small business owner who is a client of ours, or we're running through a process, we're at the lower middle market kind of, which is the first institutional capital. I mean, they're buying the business for the people, for the business model, and they're looking to grow it because they grow it to a bigger business. Then that transaction sells it to a bigger business, and that's kind of how you get to the enterprise level of kind of the capital markets here in the U.S. So there's a lot to be said for the impact that these small and mid-sized businesses have on the U.S. and in our economy. and private equity is kind of the fuel to that fire, if you will.
Yeah, for
Real
sure.
quickly, you've used the word consolidation 2 or 3 times. Can you tell us kind of what that is and, how there are platform initial buys and things like that?
Yeah, sure. And that's kind of the next step is like private equity typically, your traditional private equity, or what we call like a committed capital fund. I mean, they're going to go out and raise, let's just say it's $1 billion. Well, they have specific kind of, I'd say goalposts or, directives or mandates around those dollars in terms of where they can invest, how long they can invest, and kind of that turn to generate a return for their investors, right? And so typically those PE funds will look to, invest in, I'd say kind of when they start out their investment cycle on that new fund, they're looking for 3 to 5 quote unquote kind of platforms, Martin, to your question, where, these are businesses of kind of size, scale, management, redundancy. Typically, that kind of starts in the 3 million of EBITDA, and north, kind of 3 to 20, uh, privately held, first institutional capital. And that's kind of, if you think about it, that's where they're going to start, they're going to make that investment and then they're going to take it scale and grow that business, whether it be, geographic by acquiring other businesses in other, markets or MSAs, like we've kind of seen in some of these contractor, consolidation strategies, or they're going to buy products, services, elsewhere to kind of bolt onto that platform and to build that portfolio of brands and grow that business.
Yeah. So I think what would be helpful, I want to talk about how a company can get acquired. I don't know if you have a ideal client story or a transaction that's happened that would really fit this, but I'd love to kind of walk through, okay, I own a company. I'm looking to sell. I'm looking to get acquired. Where do I start? What is a PE firm looking for that's actually going to drive value for them that I can, focus on in my strategy for my company? So is there a company that we can kind of take through this entire process, or maybe we can just pick and choose from different cases?
Yeah, no. So that's a really good question. So, it really kind of comes down to, kind of that, and again, I don't want to borrow for book titles, but the entrepreneur mindset or, kind of the business owner mindset of like, all right, kind of taking a step back, looking in the mirror and be like, all right, I've grown this from, let's just say 0 to 10 million. I mean, there's different kind of like, I would call it like kind of tranches in the, cycle of a business. There's kind of the 0 to a million, which is, hey, I'm, especially kind of if we back into the contractor, right? Start up, I could kind of do my own thing, maybe hire one guy that I could work with me, and we could probably generate, if I'm a good skilled craftsman, probably 0 to $1 million relatively, with some marketing and some word of mouth and, the community. I could probably kind of grow that business from 0 to 1, right? Well, going from 1 to 5, that requires hiring additional people, taking yourself out of the truck into the day, into the office and, building that business, right? So that's 1 to 5. When you go from 5 to 10, that's another type of a lift because you're going to need to bring in kind of probably to Martin's point where he'll talk is you need to bring in somebody that, understand that you can trust, managing your financials, running your books, doing scheduling, doing dispatching, doing sales. Now you're starting to kind of build those pieces. And,
Yeah.
from 10 million to 100 million, I mean, that's another type of a skill set, that requires, that type of leadership and those types of skills. Now you're further and further removed from the truck and the trade and the product and the service or the invention. And so, kind of taking a step back and being like, everybody kind of sees all this stuff and be like, all right, well, I scaled my business to $200 million of revenue in whatever time frame. Well, there's a lot of blocking and tackling and a lot of work and a lot of networking and a lot of aligning yourself with the right people, to do that. And you're really kind of taking an honest step back and saying, all right, do I have those skills to, kind of take it to that level? And is this something I want to do? Because it requires investment from you as a person. And
Right.
so that would be kind of the first step is kind of doing that realization. And then, once you're ready to say, hey, I think I need a partner or I've got this new opportunity or new product or new service, that's where you say, all right, can I do this on by myself? Or, how big is that opportunity? Is that where I go out and then bring on, a capital partner or, somebody else to kind of help, solve that problem and capitalize on that growth?
Hmm. Okay. So first you have to have the realization of like, what do you actually want, right?
Yes.
And you've got to figure out who you are, what you're capable of, and where you want this to go. Do you want the lifestyle that's required to get a company to 200 million by your, you leading the charge from 0 to 200? That's a lifelong endeavor that is full of obstacles, ups and downs, and an evolution of who you are as a person, even and your
Correct.
lifestyle. So you have to come to that realization. Then you have to define the opportunity that you're actually going after. So let's say that we're home service business. We're trying to get to, we'll say 20 million, and then we're going to exit to private equity. We've defined our opportunity. What are they actually looking for in a company that size? What are the things that are going to help me be valuable to that kind of buyer?
No, that's a great question, and kind of over the last couple of weeks, I've attended several kind of conferences. I was out at the Service Titan Pantheon event, and
Nice.
just talking to contractors, across the country, and that's those are the goals, right? And so what does that look like? And I will tell you, kind of starting backwards from a buyer perspective, whether you're a potential platform or an add-on. The buyer of the business is, here's what getting back to the banking term, they're trading dollars for assets, right? And the least amount of work that you have to put in the assets after you buy them, the quicker they can generate a return. And so, that's kind of what there's been a shift in the last couple of years when we kind of started earlier on in the podcast saying about how there was kind of like a land grab, and anything with like an EBITDA was acquired. And there was a lot of market people in the market kind of making and driving up those multiples. Well, now what you see is these platforms have all, gotten smarter. They've integrated. They're all on, running a certain, Service Titan as the software platform. And so along with all these different add-ins, so now instead of just talking about like what software are you running as a company, they're saying, all right, well, what's your tech stack look like? Are you using some AI tools and, all these sort of things? And so that's what the buyers now, in order to kind of get that fully, full value of a multiple or of your business. I mean, they want to say, they have a specific kind of check the boxes. They go down through operations, finance, sales, marketing, the business model, the tech stack, recruiting, training. All those things kind of factor into quote unquote that multiple and that valuation. Not just EBITDA.
Yeah. So what I hear you saying is, as a contractor, you not only need to be thinking about how much money you're generating, EBITDA, what your revenue is, and what your team is, but you also need to be thinking about the structure of how you get things done, not just with software, but even with something like EOS, like implementing cadences where, hey, we are doing level 10 meetings, or we have a VTO that we do, and scorecards, or okay. So just the more structure you can get, and really that's just, you're trying to replace yourself in some of those cases where if you were to leave, can they run it without you?
100%. Well, that's part of it, but then also too, like, can those people, that you've trained and put underneath you, can they run it as well and or better than what you have done? And like we've seen, in many cases where putting in EOS and being on EOS, I mean, people recognize that as a value driver. So that will create, a higher value at exit. Being on Service Titan and being integrated, across the board, that does drive value, because now you're trading like expertise to the buyer that they're picking up, that they may not have tried that on their own, but they're seeing how well this little business is doing that we acquired. And now they're going to scale it across their whole platform and drive value, for their investment. So those are the things that these buyers are looking for now, versus just kind of stacking EBITDA is kind of the term that we've heard.
Yeah. No, it's such a good point, because I think, and I make this analogy sometimes with, I've talked to people about websites, and they're like, oh, well, we're going to do this like custom developed a website on this obscure platform or something like that. And yeah, that's cool. Like, you're making this Lamborghini of a website. Awesome. But how are you going to service the website? Just like, how would you service a Lamborghini? Well, the services on the Lamborghini is crazy, and it's hard to find a mechanic, and you got to be in a specific city, and it like just to get a headlight replaced costs a fortune, right? Well, the same thing. If you're using an obscure software to manage your jobs that only a couple thousand people use, when you could be paying maybe a slight premium, but not much per month to use something like Service Titan or, HubSpot or whatever it is. That's a large company that has a lot of individuals trained on that software, a lot of support, a lot of infrastructure. You're going to be better set up to find someone to be able to fill that job, just like they'd be able to find somebody to fill you, right? So, really, really good. Okay,
Well,
so
I think kind of on that point too, like a lot of business owners, they kind of like live more myopic, and so they're always like, well, I do stuff differently. At the end of the day, you're a contractor. Call comes in, book the call, kind of convert that to a job, do the work, quality. I mean, that's kind of the workflow. And, by going kind of on an industry standard solution that, may need some special kind of maybe customizations or something for your business. But, with the user base that they have, they're getting kind of all these questions when you think you're unique. I mean, they're getting it from, basically probably the guy next, in your same market, the guy next door, so, you're kind of standardizing that, but then it really kind of boils down to execution, right? And the software is just a tool and it's a platform to get things done. And quite honestly, I mean, this kind of, we're starting to see now, like in kind of under LOI and diligence, there's, kind of service type specific consulting groups out there that are coming in, getting a username and login and basically doing an audit of like, all right, well, how much do you actually use service type?
Yeah.
And
exactly.
what's your kind of like efficiency score? Because that will determine like how much upside, they have, as a buyer. So like all these things are kind of critical to your regular process and kind of going back to the question, maybe a couple questions ago, but, being prepared and having an advisor that, that knows this stuff, is talking about deals and getting kind of insight in the industry, kind of helping you position your business for sale at whatever time that is. I mean, that is value add.
Oh, for sure. For sure. I think a lot of times we try to, and I like the word you used, myopic. That's not my vocabulary, but we try to be, we try to be so unique and different and differentiate with maybe the process or whatever like that. But we just need to differentiate with the execution, because when we try to differentiate with the process, we're only adding complexity. And complexity only anchors us more to the business and makes it harder to sell. Right. That's really good.
Well, so, even too, to expand on that too, like, you could be really good at marketing, but if you can't get guys there on time, they don't do a good job, they have quality issues, like, that wick only lasts so long, right? So it's got to be kind of end to end, from that initial marketing and approach, kind of to your point on the website, like, there's no flash here. As long as my website is optimized, kind of has gone through, optimized to basically convert leads, that's all that matters.
Exactly.
All the flash, all the sex, all the glitter, like all that sort of stuff, like doesn't matter as long as, every space on that web page is driving towards a conversion. That's what you need.
Right. Yeah. Okay. So they're looking for standardization. They're looking for how they can turn their dollars into assets that can run without them, essentially, or with people that they can easily find to run the asset. What are some ways outside of just the standardizing that in growing revenue and margin, what are some ways that owners can increase the value beyond that?
Yeah, I think, the biggest one that I see, and I've kind of mentioned it on some, in conversation and when we kind of, take a look at business is culture. And I think the biggest thing that kind of is maybe a potential misnomer, especially like in this, kind of what I would call the lower middle market space, when we're talking, businesses from, maybe 5 to, 150, 200 million in revenue, and kind of a transaction size in the 10 to like 150 million is culture. And, management style, culture, the employee engagement is all super critical, because at the end of the day, whether it's a business service business or manufacturing, I mean, there's obviously there's assets, hard assets, inventory, steel, HVAC equipment, trucks, like all this sort of stuff, but there's people that need to operate them. And, at least I haven't seen anything, coming soon where AI is going to replace an HVAC tech or a plumber or, any of these essential services. And actually one of the slides at Pantheon, they showed kind of the list of industries, kind of top 10 industries that are at least, kind of most likely to get replaced by
least
AI,
likely.
least likely, and trades was the last one on the list.
Yeah.
And so kind of making sure that, people are the most important thing. So, aligning
Christian,
incentives. Yeah.
well, no, I agree with you 100%. Of the deals I've seen that fell apart, more than a few, even after they were consummated, they're culture deals. I mean, the people weren't what they thought. How do PE groups or buyers attempt to measure that? I mean, everybody just got to be smiling while they're visiting. And you haven't even told the people that are supposed to be smiling that you're selling. But literally, how do they go out and evaluate that?
Yeah. Well, and so, here's an interesting statistic that kind of I've, kind of come across. And it's, it may be anecdote, I don't know if it's quantifiable, but just in kind of my conversations with some of the large kind of consolidated platforms, is like somewhere between 7 to 8 deals out of 10 are basically, sourced proprietarily, meaning no banker, no advisor involved. So it's the private equity owner and the platform that they're, the business. I mean, they're basically making that one-to-one handshake, with the business owner, and kind of, Martin, to your point, hey, I'll give you $10 million. Well, sounds great, but is that really the right value? And so, where kind of the rubber meets the road is you sign up under an LOI for $10 billion. And then the buyer comes in, starts getting to know you, start running numbers, I mean, they're looking every single interaction they're measuring.
And they're also trying to wear you out because upon further evaluation, we're offering $5 billion.
And then here's why.
And you're tired, right? Or you're exhausted, so yeah, I'll take it. I mean, that doesn't happen all the time, but go ahead.
Right, yeah. So and so that kind of was a statistic that really kind of struck true to me, was like, all right, wow, this is very interesting.
Christian, sorry, I'm going to press pause really quick. I think what you said is really significant. You said 7 or 8 out of 10 deals are basically the private equity side approaching the business owner to go under LOI for the purchase of a business. What is the equivalent to that? Because I think sometimes we talk in these business terms, and some of the listeners are going to be like, okay, cool, but like, that's kind of ridiculous that they're not even doing the due diligence of like, what is my company even worth? Like, how can I set up to structure this the best possible? Like, am I right?
That is absolutely correct. Yes.
So like, what's a good analogy that we can use for that? Like selling a car and not, I don't know.
Well,
is there a good analogy?
Yeah. I mean,
No realtor, no attorney selling your house.
Yeah, I mean, it's literally like someone
without mowing the yard.
Yeah.
Yeah. It's literally like someone coming up and trying to buy your house from you and just giving you a price, and you don't even know what the comps are in the area. You don't, I mean, it's like taking candy from a baby is kind of what it feels like, honestly.
I mean, it's almost like, kind of, maybe it's like the HGTV, again, it's maybe like the HGTV, like the house flippers, right? Like, I mean, they're buying, distressed properties, or properties that they find that they think they can get a good deal on and turn them around for a profit. And that's kind of what we've seen kind of transpire is, hey, I sold my business to these guys, I like them, right? I mean, they valued my business a lot more than my other really good friend Tom. Tom's plumbing, I mean, he runs a pretty good business, but you as the external person don't know what's on the inside. And Tom got a 5 times multiple and I got an 8. I mean, there's just all those different factors that weigh in. I mean, it's really just kind of, you're buying the first thing on the lot in terms of, a car hits the market, right? Without shopping around for pricing exactly.
Yeah.
Et cetera.
Those guys have a sign out that says, we buy junk, we sell antiques.
That's great.
Yeah.
No,
Okay. So I took us off base, but I think that's such an interesting stat that you mentioned.
Well,
I don't want that to go by. It's basically just saying, hey, before someone approaches you, do your own diligence to figure out what you're worth, but also, just like in your instance of the remodel, if I changed the countertops, I could increase the price by, a significant proportion of money, and it would cost me just a little bit of time and a little bit of energy to get that done. It's totally worthwhile. That's essentially
100%.
what your firm does as an advisor.
Khalil, I don't think you took us off point. I think that's the most important point that I would like to see people get today is be aware there are things you can know that will work to your advantage, and you've got to find people who can help you with those.
Yeah, absolutely. Quick ad break to tell you a little bit about OpenPhone. If you're a contractor that has a single cell phone, you're probably inundated with text messages and phone calls, oftentimes that you can't be responsive to or that you can't answer at all. So what's the solution? You can buy another office line with Verizon or AT&T, and you can have an iPhone that is passed around from employee to employee, depending on who's on call. But what if there's a better way? What if there's a way that you can have all your phone calls recorded to go back and listen to later, transcribed with summaries so that you can get a quick glance at what happened during the phone call, and even connect it to your CRM where all your other customer information is? OpenPhone is the perfect solution because it does just that. You're able to add all the users you need to for whoever needs to have access to the lines for your company phone. And then you can also find all of the information you need at a glance with a centralized location for all phone calls and text messages with your customers. Whether it's for marketing, for sales, or for service, OpenPhone is the perfect solution for you and your team. If you're interested, we have an offer down the show notes from OpenPhone. Please click the link down the show notes, or you can see it here on your screen to be able to find more information about OpenPhone. Thanks for listening. Back to the episode. So I'm not sure exactly where you were going after that. If you remember, great. If not, we can go somewhere else. But I just wanted to get that point out.
Yeah. Well, and a real live anecdote. I mean, we closed the deal back in May where, I mean, that was a 1.5 year long engagement. We came in and we started, kind of the process. Our client had an electrical kind of commercial contracting business underneath. That was kind of the legacy business that he had started. And then kind of that branched into doing some HVAC work. And then he ended up starting a plumbing business. And then he kind of pulled off the resi side, kind of put the resi business together. And that was, kind of in growth mode and growing. And the commercial electrical business was there. I mean, when we got engaged, I mean, he originally, he wanted to sell both businesses like at the same time. And we said, hey, well, let's pump the brakes. There's some work that needs to be done over here on the resi side. Let's kind of work on that while we simultaneously, kind of work on offloading, and finding a buyer for the electrical business. And so that was a 1.5 year long engagement. And what it did is it basically kind of set the stage for the business as a standalone. And originally kind of we were thinking, hey, this is going to be an add-on transaction to some of the bigger players kind of in the market that he had known over the years. His friends had sold to these guys. He liked their business model. They were all telling him what was great. And when we went through a process, we had all those groups through, and then we found a group that said, hey, we want to take kind of your plumbing, sewer, drain business, and we want to create a platform around that. And that's going to be kind of the first 1 and 2 trades, and with HVAC being third and electrical being fourth, where we think we can help, you along with your team and some of the other areas in the market. Like we think we can grow this to 25 million of EBITDA for free in the next 2.5 to 3 years. Oh, and by the way, we've done it before. So it was kind of like, our client kind of walked away out of that meeting, was like, whoa, this is really interesting. Let's check that out.
Can you explain for our audience what it means to become the platform company in that?
Yeah. So that would be, essentially it's the first investment, kind of in this asset class. So, they basically were targeting that type of, the business that looked like that. And so to be a platform though, kind of to, earlier conversation, you got to have, kind of check all the boxes. Service Titan, been running it for years, using add-in tools, training, development, sales training, recruiting. I mean, they have to have all that framework and, pieces of those businesses built out so that when you go and acquire another smaller business, there's something that you can transfer from the platform to the, to the smaller business and say, hey, we're doing it this way up here. Let's do it down, this way down there. And then now you're basically, buying businesses and you're able to like organically grow all the acquisitions at a 20 to 30% clip because now they're executing kind of like that platform business model. And that's kind of how these guys can grow and scale rapidly.
And if you become the platform, like if you sell as the platform company, typically the owner gets a stake in the platform. Is that typical?
Yeah. So there's that we would call a rollover equity. And so, there's a percentage of that, typically it's kind of buyer owner discretionary, a transaction point, how much to roll in. But, when you're the platform, you're at the same basically investing class and value of stock or membership, that that the financial sponsor and investors are at. So when
Yeah.
you're, versus when you're add on 55, I mean, you're buying into a business that's already gone through, several different iterations of valuation markup as they grow into that, so now your dollars, your upside or your multiple on your invested capital or the rollover dollars, you just have a shorter window or, there might not be as much with rollover value, when you're that far down the line. So being a platform and being early on in the cycle allows
Yeah,
your
it's
dollars to
tremendous.
work harder for you. Well, you don't.
Exactly.
Well,
Yeah. And
they'll
that,
typically take out something. I mean, as cash, some deferred
Yeah.
payment,
right.
and then that's equity part's a second bite of the apple. I mean,
Yep.
that's
Call
the
that
way
the
it always
second bite of the
gets.
act. Second bite of the apple, additional upside.
Yeah,
We've
yeah, it is.
had several examples where, the second bite of the apple is actually
It's
worth more
way
than the
more.
first transaction
Oh yeah.
Yeah.
in those cases.
Okay. So we've covered, you know, the differences, what it looks like to be prepared for, selling to private equity, what makes a difference there. How can you, I mean, how far in advance do you advise really planning for this sale?
Well, I would say, as soon as possible. We
Okay.
we like to have, from our perspective, and I would say, what we like to have versus, it's kind of like, hey, what we like versus what we get.
Right.
Typically what we get is, we get an engagement and it's like, all right, I want to sell my business, and it's right away like moving to let's start moving materials, go to market, etc. Where we like to be is, a year, 2 years, 3 years, I mean, there's conversations that I've had, for 5 years with certain folks that eventually they're going to transact. And when they're ready, we hope that they kind of choose us,
Right.
as we, kind of check in and help guide. And the more that we can kind of have our, not necessarily like we're not doing any of the work, but it's just advising and kind of being that third party to check in and check out on, all right, do I make this decision? Should I make this decision? Being kind of that sounding board. Most owners, they really just have kind of, said they've got their teams. They talk to some of their buddies. They talk to these buy side brokers and, all the people that are kind of calling inbound. I mean, they're going to tell you what you want to hear, but actually having somebody on your team that says, all right, I think, looking at, software X, Y, and Z, even though like it's a great development firm, you probably should go with Service Titan if you want to get max value because everybody else has it. And if you don't, they're going to have to basically rip it out and integrate it anyway. So you might as well have it.
Right.
I mean, like that, and then as you grow and scale, your mistakes, they, the mistakes that you make, the dollars are bigger than when you're smaller. And so
Yeah.
kind of having a sounding board and having kind of people that are in the room and that you can chat and bounce ideas off to, see them at trade shows, check in, et cetera, do walkthroughs, having that, kind of advisory, board or whatever really adds a lot of value because, they're the ones that can kind of help, kind of steer that process so that when it does time to go into market, number one, a lot of the buyers know about you and know that, an advisor has been in there kind of working. So they know that they're, going to get a business that, is not as rough around the edges, if you will. So
Yeah.
we kind of, put everything into practice.
Yeah. Okay. Mistakes. Obviously, we've, implementing the wrong software just because it saves you a buck or because it's unique to you or whatever it is. We've talked about waiting too long or not even talking to an advisory firm like yourself. What are some other mistakes? And then I remember now we had mentioned culture and I do want to go back to that, but let's talk about mistakes really quick.
Yeah. I mean, I think, from a mistake perspective, I wouldn't say like mistake, but more like learning moments, is, from an owner's perspective, we can't underestimate, the proper, kind of spending the money up front to make sure that your accounting and your chart of accounts and, every, that kind of the foundation as you look, I mean, we think about, we use a lot of housing analogies, right? Like making sure that the foundation is solid and secure and kind of the house is in order, because that allows you to, not just make sure that, I mean, and there's a handful of opportunity. I mean, we're talking about kind of a lot of these, trade businesses. I'm sure everybody has stories. Martin probably has it. You probably have them, but, like the fraud and some of the waste and, so there's some that you just definitely have to be on the lookout for some shady characters out there, right? Not just in business, but also everywhere else. But, making sure that having your financial house in order and having a CPA that you trust and kind of having that level of checkoff and kind of checks and balances so that, that piece of it can be, managed, and then you can build on top of it because that's going to provide your KPIs and your management, what you're going to use to run your business and score your business and grow, kind of having all that stuff done and having it done correctly, not just on the cheap or for, using Google or whatever, but like having a proper advisor, kind of help you build that is super important.
Is that the number one that you would say in terms of money up front is on the accounting side or the finance side? Just having really good books and really good KPIs?
Yeah, I mean, I think it's, obviously, I wouldn't say like number one up front, but it kind of depends on where you're at within your, with the size of your business, right? But I think that's something that often, what happens is you start out the business, you get going, you get inertia, sales, everybody's tracking revenue. At the end of the day, your business is valued on profitability. So, making sure that, having kind of that frame of mind, say, well, we do need revenue, but we also need to make sure that our revenue is getting accounted for properly. We're able to spend our revenue the right way and have money left over to spend it. And I think the other thing too is making sure that you have, and I've seen a lot of like the best businesses that we've sold, like all the employees are bought in. They all have, they're aligned. There's a team. It's not just, coming in for the hourly paycheck anymore. It's like making sure that incentives are aligned and making sure that the culture is such where, hey, and if you're a business owner and you're driving in, kind of going back to the Lamborghini model, like you're driving in, pulling into the front, with your own parking spot and, having that type of a culture. I mean, that's picked up on real quick by a lot of the the private equity guys that come in. And also too, it shows what how you value your employees, right? Kind of having that level set and having a team culture. And it's not for me, it's for all of us. Because that is something with churn and employees that will get measured, right off the bat.
Just a quick anecdote. Had a company in Oklahoma City that sold, nice exit. And the owner said the PE guys made it abundantly clear the day they decided was when they visited their huge warehouse and nobody in the shop knew who the owner was. They didn't know who he was. That's how independent they were from him. But that brings me to another question that pops up every time I've been around it, and that is when and how much do you tell the employees? That's a big question.
That's a great question because it really depends. On the scenario, because we'll kind of do our evaluation and depends on the goals of the owner. If the owner is like, hey, I want to transition in like 6 months to a year, well, we need to kind of, we do our assessment of like, all right, well, what does your second level of leadership look like? Is there somebody there to take the reins that can step up, et cetera? And if we get, favorable responses and that, we'll take our time, like we talked about earlier, like saying, hey, let's just elevate this person now, run the business as we work on materials for 6 months. And then we'll include, her, he in the type of process, because that's the person that's going to be driving the business forward, past that 6 to 12 month time frame. So, those are the types of like, we're playing kind of chess, versus checkers, with our clients saying, all right, we got to make sure that this business, is in the best, put our best foot forward, when we're approaching these buyers. Because really, in all reality, we've had several, scenarios like this where, our client has said, oh, we've only talked to a couple of people so far, and then, we go do all the work, do all the materials, and we try to send them, and we know the buyers and we think they'd be great buyers for the business, but they've already kind of seen enough to be turned off when, we're presenting a business that's 6-8 months down the road from when they originally had those conversations. And, they've already kind of moved on, let's put it that way. So
Well,
that kind of is very important.
just kind of back to the idea of when do you tell the employees? I guess the answer is it depends.
It depends.
And
Now, when you get to, and sorry, I was talking about more on the management side, right? But when you tell the employees, we typically like to hold that until almost like everything has been signed.
No, that's fine. But you're saying then you take to management, and at the earliest opportunity, you make it known to them and their role, possible role,
correct,
in the post-transaction business.
Yep, okay. Absolutely. And the kind of the analogy and what I like to talk to our owners about is like, hey, at the end of the day, if you take a step back, these are the people that have helped get you and the business to this place, and let's set them up for success and reward them for all the hard work and the value that they've created and the value that they're going to create in this new partnership and this new opportunity for them. Because transacting with a larger group or financial private equity group kind of opens doors for them to show their skills and provides upward mobility for them versus just working for you. Because you're the CEO, you're the owner, there's nowhere for them to really go inside of your organization. But now when you kind of open that up and you partner with a larger organization or a strategic or private equity backed company, that skill, their skills and their effort can be really recognized and they can be rewarded for that. And we've had several cases where just kind of playing through the scenario where we came in, we elevated a woman. She was kind of running everything, but didn't have the title, put her in as a kind of a GM, ran the business, transacted. The two owners of the business stepped out. They were kind of transitioning out anyway, but just kind of put her front and center. They were out of the business within 3 to 6 months. And then she basically kind of took that business forward. And now I think she's like a, multi-state regional VP for a large publicly traded company. She grew up in, kind of eastern, kind of northeastern Kentucky.
There you go.
And an exceptional career for herself and her family and all that sort of stuff. So, we have several examples like that.
That's wonderful. Really cool. Okay. So I want to go back to culture really quick. What are some things that separate great cultures from the mediocre or the average culture? Like, what are the biggest things that stick out to you that more owners need to be thinking about intentionally that they're not?
Yeah. I think if I take a step back, kind of as a business owner, kind of your job is to provide, kind of tools and, and basically, tools and kind of tips and direction on, for people to how to get stuff done. And so the less kind of what I would say, the better the tools that you put in, the better the business can perform, and making sure that, those people are trained on those tools. And I'm kind of referring to like, let's just take a look at operations and, a software application as an example. Well, having people do, spreadsheets, move paper, all that sort of stuff. That's not kind of creating value, but, now you give them and put them in front of like ServiceTitan, and they've got all access to all this information, and they're allowed to kind of make decisions and empowered to help kind of drive the team forward. Everybody's kind of working towards one goal. That's a really good culture. Everybody, gets along. Not to say everybody gets along all the time, but they, kind of having that hands-off ability and kind of trusting that your team can, do and execute the business without, and love what they do without having to kind of be there, sitting over their shoulder, telling them what to do, the orders, the kind of the old style system, but, having an empowered kind of workforce in order to kind of solve people's problems, goes a long way. So those were kind of be the check the boxes in terms of culture. It's a lot of times we think back to like, team sports, right? Like, having your team, being in the locker room. Well, a lot of these contractors, that's kind of what you have. You have that type of a culture, and the good ones do it really well and they reward their employees for it. And the poor ones are just, now you're just basically buying labor, right?
Yeah, exactly.
Versus empowering people to make decisions. And, I think what was kind of cool coming out of the ServiceTitan convention was, some sayings and anecdotes is that, all right, well, if I can, improve my close rate by 10%, well, that's $40,000 more that I can spend and give to my technicians. And kind of looking at it
Yeah.
like holistically saying, all right, well, we're doing these things so that, everybody can make a really good, wage and, kind of meet their goals, from a financial perspective, take that off the table. And then we're just having fun and growing the business type of thing. So kind of putting a lot of that type of stuff in place is really important to growing and scaling your business.
Yeah. No, that's really great. Really great. Okay. We've covered a lot.
I got one more,
Martin,
Khalil.
last thing, go for it.
Yeah, that'd be the last thing. What's it look like to work with you? I mean, do you guys take a share of a sale proceed? Do you charge money as you go along? And I mean, what's it look like?
Yeah, so it really kind of depends. And again, kind of going to depend. But if we wanted to kind of take a longer approach, we could kind of do something where, kind of having us as it would be kind of just compensating us almost as an advisory board until there's actual transaction. But typically, we are on a success fee basis and get a percentage of the sale. And obviously some sort of like, we call it like a commitment fee, and just to kind of align interests so that we can kind of do the materials when timing's right. So there's like a little bit of upfront potentially, it just really depends on that side, but typically we're success fee driven on the backside of it. And like I said, we're incentivized just like you are. The more value that we can create throughout that process, the higher our fee is. And we've never, every single deal, we always pay for ourselves. So you're getting, always ROI.
Yeah.
Especially when 7 to 8 deals out of 10 in the contractor space are done without an advisor.
Yeah. Especially if you've seen an offer before you came in, you can prove it.
Oh, absolutely.
Yeah. Cool. Well, you are with Footprint Capital. We've heard about you a little bit throughout the process, but kind of summary of like what separates Footprint Capital from the other bankers that are out there.
Yeah, I think one of the things that we kind of pride ourselves on is like nobody from our team actually kind of like we just hire one. It kind of came from an investment bank, but
okay.
Most of us have, venture capital, commercial banking. I spent, a majority of my kind of early career in, on the corporate buy side. So working for publicly traded companies, looking at acquisitions and buy side opportunities. So did that. I also ran a business. So I operated a $100 million business inside of Ashland Chemical, which was a great kind of like, hey, I've been looking at deals, doing transactions. All right, stepped into the chair and ran that for 3 years. So, we kind of take a different approach towards, all right, well, if we want to, maximize the value, like let's kind of, like I said, take a step back, evaluate different areas of the business and, can we improve these? And is the investment worth the reward on a sale? Or is that something we can kind of just leave to the side and, not kind of make it part of the core story, type of piece of the business that we're going to be transacting. So kind of having that different lens and kind of being in an operator perspective and wanting to kind of grow and, grow businesses is really kind of what differentiates us, I think from kind of the, hey, we'll send us your financials, we'll put them into our, model that spits out, on our website and we'll set a price. We pride ourselves in, we do a broad client auction approach. So we're actually making sure, and I think the one thing I missed on the last comment was, not just by, with our group, we're going to help you find the right partner, not necessarily, are they the ones that are going to, pay the most for your business right out the gate? I mean, we have a lot of people that, a lot of times we will get, in a process where we'll go out with the materials, we get, indications of interest or kind of preliminary bids. And, there's a lot of times where, our buyer ends up going with not the highest one that was at that initial onset, or the one that they thought was going to buy the business that had communicated and said, hey, we want to buy your business. Typically you find the buyer comes from somewhere else and, we're crafting and making sure that process, is the right fit, before kind of making that decision. Typically if we've got two parties and one is a higher value and our owner likes, the other group, maybe a lower value, I mean, I'd say 9.5 or 9.9 times out of 10, we can get the one that he likes up to this level of economics, and we can move forward there. So that's, kind of it's a little bit of inside baseball on some of our stuff, but really kind of knowing that process and how to manage, that throughout the process really kind of differentiates us, versus some other groups out there.
Yeah. Very cool. Well, we'll link to Footprint Capital to your LinkedIn as well in the show notes. And I love what you said. I was asking if you guys do, consultations or anything like that. Like, I pick up any phone call. So we'd love to get people in touch with you. We'll put links to that in the show notes. And give Christian a call if this is the journey that you're on. Thank you so much for your time, Christian. It's great to talk to you. Great to learn about all the different things in the world of getting acquired. So
absolutely. Thanks for having me on, guys. And like I said, any questions come up, happy to, like I said, to take a call and answer questions. I mean, that's part of the journey. This is fun stuff. So especially, you get to sit in this chair, you got to be like, Martin, you guys, right? You got to be kind of a deal junkie and like, you don't like this work because it's, it's 24/7, 365 sometimes, but it's fun.
Yeah, absolutely. Okay. Well, thanks, Christian.
Thank you, sir.
Right. Yep.
Bye.
You made it to the end of the episode, but before you go, if you found yourself thinking about growing your construction business while listening today, I want to share something with you. It's called our 24 Things to Hiring and Training the Perfect Executive Assistant for Your Construction Business. And it's a free guide that we've created. It's not theory, it's what we actually use to help contractors hire the perfect executive assistant. And really, we help you find ways to delegate over 50% of your current workload and get back 20 hours of your time every single week. You didn't start your construction business to just be doing admin work, to be buried in paperwork and endless admin tasks. This is the guide that shows you exactly how to find and train someone who can actually take all that weight off of your shoulders. So this is a real actionable, great PDF that has templates and processes. It's really, really great. And I want you to check it out, even just to get your feedback and how we can make it even more valuable. But I know that you're going to love it. The link is in the show notes. Please download it. We'd love to see how much of an impact it makes on you and your business. Thanks for listening to the full episode. Check out the guide. It's free. No reason to hesitate. No reason to wait. Download it now. And before you go, I just want to ask for your gracious subscription to our podcast. So if you have 2 seconds, it means the world to us. Just subscribe on YouTube, Spotify, Apple, or if you'd like our weekly newsletter delivered to your inbox whenever we release an episode, please subscribe in the show notes. Every week, we're talking about real strategies on how you can grow and build a profitable construction business that runs without you, so you can have less stress, more time, and more money. Click subscribe wherever you listen to the show, and thank you again for checking out the Cashflow Contractor. See you on the next episode.